It's turning out to be nothing short of a black Monday for global markets. Why a black Monday? Because across the board, things are in a tizzy. A word which I've rarely used to describe the financial markets in post-COVID is that there seems to be a selling stampede, at least in Asian markets, a lot of developed markets, and not just equities, Bitcoin, commodity, and there seems to be a huge jump in volatility. Now, why is that? What has changed in last 3-4 trading days that from growth we've moved to a concern on recession? Commodities are melting as if there are no takers, and the yen trade is reversing as if there is going to be a very large risk in the financial market. I think today's selling is more technical in nature. I think it is largely because of unwinding which is happening and across the position, and this for me, it is a risk-off moment. Historically, when markets have fallen, at least in last couple of instances in India, it has always turned out to be a buying opportunity. So should you be buying the fall, or this market has potential to perhaps cave in much more before it gets better? Is it time to go against the trend, which is be a buyer, or one should look at just capital preservation rather than capital deployment? Remember, we are coming off a extended rally which we've seen both locally and globally in equities, especially in last 3 months. So with that backdrop, let's look at some data. What is spooking the market? I can say I'm not so sure if these are the only factors. It is pure risk off, and I think it is prices have moved and we're trying to put the reason. I mean, the same recessionary fears were there 2 years ago.
Correct.
Yen carry trade has reversed 3 times in last 5 years.
Yes.
And which is the third point, tension in Middle East. Yes. When the war happened, markets didn't come down.
Correct. Correct.
And today markets are taking notice of it. It's a risk of trade, Kunal. Yeah. There's no point in justifying with reasons.
It's a risk of trade. It's a sudden repricing of the risk, and I think, the factors which have come together as a concern for the markets. And I think more importantly, the data which came on Friday for the US jobs data, I think that could also be one of the reasons why the markets are suddenly repricing. But so we worked out on a lot of stats over here, Nikunj, and one of the data which tells us that the CBOE VIX, or that's the key indicator of the US volatility, that is very interesting because whenever the VIX has jumped about 25 levels or given a rise of 25% plus on a single day, what that resulted into the US markets. So we did a study on S&P, and it tells you 1 week, 1 month, 3 months. So we've taken these 3 time frames. Whenever the VIX has jumped about 25 or 25% plus, in the next 1 week, the index has fallen by 3%, but that's been the floor for the index. The next 3 weeks, the index stabilizes at 3%. But the best part is, in the next 3 months, from the day of the sharp rise in VIX, the S&P index is actually up 4%. Many instances where S&P is up 10% also.
We're talking about S&P 500 in America. We're not talking about the Indian S&P.
S&P 500.
Okay, US S&P.
Yes, US S&P.
Okay, so let's revisit that data. It's fantastic data, Kunal. Thank you. That's his proprietary data. Advantage of watching it in Kunal's proprietary data. What Kunal is making a point, which is that when VIX goes up by 25% for S&P, it has always, in hindsight, turned out to be a time you should be putting capital to work. Why? Because these are the instances, and the more you go in terms of long term, the more chances are in terms of a magnification. Right. When did we see this kind of a spike last in global S&P?
I think very recently was in 2020, of course. Okay. We know the COVID sell-off. 2021-22. There were also 2 occasions when the VIX has actually spiked by 25% plus. And both of those occasions, very recent, these are very recent occasions, but I'm giving you accumulation of the last, I think, 30 instances where we've seen in the last 30 years of the data for VIX.
Okay. Now there is the August seasonality, and here's some data which you want to take it forward.
Yeah, so I think this is fantastic because I actually thought that maybe this could just be one-off. But in every even year for the markets, the Nifty 50 has actually given a positive return. Now, these are times where even in 2008, when that the GFC was going on, 2020, the COVID scenario uncertainty going on, 2012, 14, many global market tantrums were there at that time. Even in those scenarios, the month of August after 2000, the year 2000, which means the last 12 instances, has always yielded positive returns for the Nifty, and we are positive by a margin of 3%.
So Kunal, let's summarize it, and then Jim is also ready. I'll say hello to him also. You are making a case that, look guys, this is looking ugly on paper today, but soon things will stabilize.
Exactly.
And for those who always wanted to buy, courtesy global markets, you're getting a chance now to really perhaps buy that stock.
Correct.
Or buy some stocks which you always wanted to buy.
Yes.
So don't be scared from the index.
Correct.
Maybe in a day or two, you should actually be backing the truck and start loading it.
Exactly. Yes.
Okay. Great point. Jim Rogers, good afternoon, sir. How are you?
How are you?
While looking at the markets, everybody is saying that, oh my God, have financial markets turned? Are we staring at what could be called as a directional turn for financial markets, or this is like a one-day sell-off or a one-week sell-off which would be digested?
I'm going to use the U.S. since that's more neutral for most of your audience. The U.S. has not had a problem since 2008, 2009. That's the longest in American history. So America, and therefore the world, is long overdue for a problem. And I will say to you, I have a lot of cash. The reason I have a lot of cash is because I expect the next sell-off to be the worst in my lifetime, because the debt has gone up by so very, very much everywhere. Even India has debt now. So you should be worried. I am worried. I am waiting for this collapse to come because I know it's going to be very, very bad. Maybe it's here. I don't know.
Right. Hi, Jim. That's exactly what I wanted to probe about. Is this it? Is this the start of that mega sell-off, which you say is the worst that you're going to see in your lifetime?
Well, I don't know. You should watch ET now. They know. They have the answer. I would suspect this. I am not buying what I see here because as I said, I expect the next collapse to be the worst in my lifetime. We are overdue. It's been many years since America's had a problem. You know, the world markets have had problems every few years for centuries. It's not unusual. India has been very strong, but everybody has been very strong except China. So we're overdue. I am worried. Maybe you're not worried, but I'm extremely worried because I know the next investment crisis is going to be the worst in my lifetime.
Let's try and understand what's spooking the market right now, Jim. I mean, is it just the geopolitical tensions in now West Asia, which are far spread? Is it yen carry trade reversing? Or is it just the US recessionary fears which have propped up post the employment data?
Well, usually there's no specific event which causes a market to top and start going down. I don't know a specific event except all markets have been going up for many years. The Indian market is at an all-time high. All-time high. That's true of many markets around the world. So when everybody's having a good time, it's a time to start worrying.
Jim, I'd like to draw your attention to what historically has happened when sell-offs have happened. So equity comes down, gold goes up. Money moves back into the dollar index. US Treasury, they tend to rally. But right now the screen is telling me gold, Bitcoin, US Treasury, everything is down in a synchronized manner. Why is that?
Well, often, and I know what people think, but often when markets start going down, everything goes down. Gold, silver, everything. Now, gold and silver often make the first bottom and start going up before the stocks do. So this is not unusual for me. I own gold, I own silver, as you know, but I'm not buying now. I'm waiting for a better chance, I hope.
So Jim, what is the best way right now for those who are watching the show and they said, look, last couple of years, equity markets and financial markets have been good to us. Should we now raise cash, maybe 15, 20, 25% and just put it in like a government bond?
Well, ET now knows more than I do. I have a lot of cash. I am not spending my cash yet. I would like to have more cash because, to repeat, when the next market collapse comes, it's going to be the worst in my lifetime because things have been so good everywhere for so long. Always in history, when everybody's making a lot of money, it's a time to worry. And so I am worried.
Jim, did I just spot a silver chalice? Is that where you've been investing?
Well, I have some silver, and I do have my silver chalice. Yes, yes, yes. I'm drinking tea.
So,
So is that where money is to be invested right now, other than the cash pile that you're sitting on?
Everybody has to put their money where they want. I would rather have it in silver than many other things right now.
and why is that? Why is that for many years now you've liked silver? Why is that?
Well, silver's down 40%, 40 or 50% from its all-time high. Many things, the Indian stock market is making all-time highs. Gold has been making all-time highs. Silver's down. It's hard to find things that are down. Silver's down, China's down, some agriculture's down, but most things have been going up and been very strong.
I mean, the question then is, whenever the sell-off does abate or whenever it even kicks in, we don't know whether this is the bout or not. What is it that you would be buying? Would equities be then the preferred asset class because they would have just come out of a crash?
My preferred asset class, well, if I can find a stock market that's down, very, very few, only China's down that I know of. So there are very few stocks that are down. If I were buying today, and I'm not, I would probably buy silver or agriculture.
Jim, yes, China is down, China is cheap, but that's really been the story for many years now. And a lot of old timers who've invested in China, they are also giving up largely because of the shape of the economy and the way how things are moving there. So, do you think China is cheap for a reason and it could remain like that?
You have been around a long time. You know that whenever something is cheap, it's always a good reason. The bears always tell you many, many reasons that things should be cheap. Make your own decisions. I mean, you can listen to ET now, but you should make your own decisions. And I will tell you, whenever a market goes down, there will be many bears that will tell you why it's going down and why it should stay down. You have to figure it out for yourself. I had rather buy than sell many things right now. I'm not doing either. I'm sitting here with a lot of cash in US dollars. I own silver, I own gold. If I were buying something today, I would buy silver.
Jim, you mentioned that you like agri-commodities. Now, commodities, they hunt together. That is what historically we've seen. If the world slows down and if commodity prices, they start coming down, do you think agriculture commodities will not be hit?
Well, when markets go down, everything goes down for a while. So agriculture will go down, silver will go down, oil will go down. But if you want to make money, you have to figure out what is going to go back up first. And in my view, it will be agriculture, it will be silver, but everybody has been very, very strong. The American market had its longest bull market in history. It started in 2009. This is 2024. It has never lasted so long in American history.
Jim, you've been bullish on agri-commodities for quite some time now. List out what's looking attractive and where is it that you find valuation and price comfort?
Well, I've been optimistic about agriculture because agriculture has been depressed. I know your parents taught you to buy low and sell high. Agriculture's been depressed. Does that mean it's going to go up? Of course not. But I had rather look for opportunities in agriculture than in the Nifty 7 in America.
Jim, I distinctly remember we had a conversation a couple of quarters ago and you said it may not be the best idea. It may be the most silly idea, but guess what? I'm still long US currency or US dollar. Why is that?
Well, I own US dollars because when the turmoil comes, people look for a safe haven. Many people in the world think the US dollar is a safe haven. It's not, but people think it is. So I still own a lot of US dollars. Somewhere in this turmoil, the US dollar is going to go up. I hope I'm smart enough to sell it. Now, I know you're going to say to me, what will you buy? I don't know. I will watch ET now.
But Jim, since you are on ET now, everybody is expecting that you would answer that question, what should one buy right now?
Well, if I were buying something today, if today were the bottom, the top for the US dollar, I would buy silver. But I don't know. I doubt if this is the top for the US dollar. If we go into a bear market in many countries, the US dollar is going to be much stronger. And I hope if that happens, I hope I'm smart enough to sell the US dollar. But I do not know where I'm going to put the money. I will watch ET now to find out.
Right. And for those, Jim, who are watching you right now, I think as important as it is to understand and figure out what you're going to buy, it's also what to sell. Berkshire Hathaway sold nearly half of its stake in Apple. What are the frothy pockets that you would say just book out right away?
Well, I have sold most of my shares everywhere in the world. A few places I still have shares, so I don't have anything I want to sell as far as because I have so much cash in US dollars right now. But I have not sold short. You ask a very good question. I hope I'm smart enough to start selling short. And when I start selling short, I will sell those 7 or 8 stocks in the US that have been so very, very hot. But I am not selling short yet. Maybe because I'm lazy, maybe because I'm not smart, but I will not sell India short. I will sell the US short.
And China is a buy, right?
I had rather buy China than sell China, yes.
All right, Jim, such a pleasure. Thank you for joining us, and cheers. Let's to more interaction, to more silver chalice. Hopefully, what's water or wine? What is it inside?
Tea.
It is always my pleasure. ET now is the best.
Cheers, my friend.
Thank you.
Cheers, my friend. Thank you very much for your time.
Thank you.
Sneha is not ready. She was ready, right? She is not ready. Let's take a break and we'll talk to her about yen carry trade after this break.
Back with this very special edition. We're calling it Coping with the Sell-Off, but the sell-off doesn't seem to be persisting, much unlike historically what we've seen when at least Indian retail participants have come in very swiftly to buy the decline. That sign is completely amiss today. We're still down about over 500 points. In fact, the Nifty futures are staring at almost a sizable 600-point dip. Having said that, it was a lot worse intraday. We even breached below the 24,000 mark in trade, and a lot of factors really which are at play. We've already talked about US recessionary fears post the employment data, the yen carry trade, which is reversing. And mind you, heightened geopolitical tensions pretty much all across West Asia, that as well have been quite an escalated figure. But let's try and understand the yen carry trade, because that's clearly been in the focus of the past few trading sessions in the wake of the sell-off. Let's understand what this really means for the financial markets worldwide. Snehi joins in to explain us exactly that. Snehi?
Well, absolutely. So first of all, let's understand why we're talking about a carry trade in the first place. It has a lot to do with yen, and we have seen Nikkei bleed sharply in today's trading session, down more than 12% intraday. Let's start by talking about what a carry trade is first of all, and why we're talking about a yen carry specifically. First of all, what is a carry trade? Now, it is a strategy that involves borrowing money in a currency that has a low interest rate and investing it in other asset classes that offer a slightly higher rate of return. Who uses a carry trade strategy? Now, while this is popular in forex traders, it is also used by fund managers who deal in equities, in commodities and bonds as well. What is the meaning of a carry trade? How do you execute it? An investor borrows money from a country with a low interest rates. In this case, it would be Japan, and invests it in high yielding securities. For example, let's talk about the Indian government bonds. Now, assuming there are no currency fluctuations, the investor is going to earn a good return by taking advantage of the interest rate differential. Now, how does it work exactly? Assume an investor wants to do a yen carry trade in Indian government bonds. He will have to first convert the yen to dollars, and this will incur him some costs. He will then have to convert these dollars into rupees, and then he'll have to buy hedges against a possible devaluation in rupee. Why the hedges? This happens because if the the rupee weakens, you will need more rupees to buy the same amount of dollars, which is why hedging against any fluctuation is necessary. Now, you must ask, we've understood about what the carry trade is. How does the Bank of Japan actually come into play over here? Let's understand that as well. The Bank of Japan recently increased its interest rate to 0.25% from 0 to 0.1%. The outcome of this was quite big because the borrowing of yen has become expensive, shrinking profit margins. Now, to understand this better, let me give you an example. If $1 equals 80 rupees at the time of investment and the rupee weakens to 85 against the dollar, it will mean that you will now need 85 rupees to refinance that $1 that you had purchased earlier for only 80 rupees. Similarly, if the yen was 140 to the dollar at the time of purchasing this loan, you will now have to give more in order to repay the yen if yen starts strengthening against the US dollar. In a nutshell, this is what happens in terms of foreign exchange fluctuations and currency trading. So in a nutshell, this is what carry trade actually means. Now, going ahead, let's also quickly understand why this has created such a big impact and what will happen if the Bank of Japan were to hike rates further. Higher interest rates could attract more inflows into Japan, strengthening the yen. Now, this could increase losses for the traders and repaying the loans could become more expensive. The hikes will cause the spread between the yen and the higher yielding currencies to narrow or diminish, and the carry trades in yen may lose appeal. So, because of all of these mechanisms getting into place, yen carry is in focus today, and that is why Nikkei has been tanking so sharply in today's trade.
Yes, that it is, and clearly bringing about a ripple effect across the globe. Snehi, thanks for that explainer. We're going to wind it up right here on this edition of Coping the Sell-Off. But even as global markets have tumbled to multi-month lows, market experts are saying that the fundamentals of the Indian market will continue to be strong and the current sell-off is just a bout of correction as anticipated. Let's hear out their opinion.
Much awaited correction has set in, and which is in a way I feel is good for markets. From a longer term perspective, in a sense, like can it be a deep correction for Indian markets? I would not think so, because the economic linkages of the Indian markets from a liquidity standpoint of view at this point in time are very low, unlike 2008 crisis, where we had lots of leverage coming from international markets, and any impact would have impact back home. This time around, all those exposures are very, very limited. And sentimentally, there could be some impact from a short-term perspective, but I do not see any big structural deep cut in the markets.
From an environment where the base assumption was probably we'll get one rate cut in US this year, now the base assumptions US markets are pricing in is about 100 basis points of rate cuts and 50 basis points, 100 basis points of rate cuts this year and probably 50 basis points going into the next meeting in September itself. So all of that does call for it's a big macro shift from a global perspective, and that would lead to unwinding of some carry trades and some unwinding in emerging markets as well. And because of all of this, I think this could be a proper correction in this bull market. But I still believe that the underlying fundamentals for India remain strong.
Our belief is the easy money is behind us, and markets are incrementally going to be stock specific. The breadth of the market has started to narrow down substantially, and we believe that this is the time where you need to be a risk manager rather than a fund manager.